very good evening. You're watching The Money Show on ET Now. This is your daily dose of personal finance mantras, lessons, and tips right here on ET Now. Let's tell you what we have lined up today on the show. A very interesting concept of personal finance ratios. For all those who are financially savvy, I'm sure you'll understand when I usually talk about ratios, it's often to do with, the corporate sector, the profit and loss, the balance sheets as well of these companies. But how can it essentially apply to your personal finances as well? This is the interesting concept that we will be discussing right here on The Money Show today with Mr. P.V. Subramanyam. In a short while from now, we will also be answering your questions and queries. Later on the show, we will be diving deep into the world of cybercrime, which unfortunately has become quite rampant, especially during this lockdown. And that is something that also prompted the Prime Minister to announce that they will be announcing a new cyber security policy for the country. So we will be bringing on board Bharat Panchal, the Chief Risk Officer for India, Middle East and Africa with FIS. He will be joining us as well on the show. And later on the show, air bubbles with 13 countries currently being negotiated, which means more places for Indians to travel to, of course, with all the safety precautions and social distancing measures in place. Australia, Italy, Japan, New Zealand, and many others are where Indians would perhaps soon be able to travel to in just a bit because of the air bubbles being established. But I guess the closest destination for now, for those people who are desperately wanting to get out of town, is Maldives, with whom India already has an air bubble. Is that a good option? How expensive as well will it be? And what are the offers that various resorts and hotels in Maldives are offering? We will get you all of that in just a short while from now in our Spend with TMS segment. So action-packed day right here on The Money Show. Let's kickstart the show without any further ado and welcome on board Mr. P.V. Subramanyam of subramani.com. Always a pleasure having you with us. So personal finance ratios, I'm sure you'll agree with me when I say that, usually we talk about a sales turnover ratio, asset turnover ratio, and all these ratios more from a corporate standpoint, from a P&L and balance sheet standpoint. What exactly are personal finance ratios? How do you apply the whole mathematical, bit of ratios to my personal finances?
Hey, Mubina, if you have a goal, let's say you have a goal that you want 20 crores for your retirement, okay? And suppose you have 20 lakhs today. For all other things apart, you have 20 lakhs for your retirement. So what you put on the numerator is 20 lakhs, which you have, and on the denominator is 20 crores, which you need. So which means you have 1%, right? So what happens is, for a person who is not mathematically oriented, they can just create an Excel sheet, putting these numbers from somewhere. Every day, every hour, anytime they want, they will know for which goal, what percentage they have achieved, right? So that is the advantage on creating these ratios. Ratio means only one thing, right? Something in the numerator, something in the denominator. So, height weight ratio, how much of protein to carb ratio, right? You can do it for food, you can do it for anything. But largely, I agree with you when you said we largely look at numbers for corporates. Sales ratio, fixed assets ratio, return on net worth. That is how we look at it. But there is nothing which stops us at looking at ratios from a individual personal finance point of view.
All right. Okay. Well, Mr. Subramanyam, which is then, one of the most important ratio for individuals to keep track of, to implement. And let's start off first with the most simplest ratio.
Okay, the ratio which tells you that, something which we call the 20, 30, 50 ratio. So 20% goes into, you say, okay, 50% will go for my expenses. 20% is what I should be paying towards, 30% should be all the EMIs that I pay, and I should be saving at least 20%. So I save 20%, I pay 30% towards all my EMIs, and 50% is what I spend on. So that is called 20, 30, 50 ratio. Similarly, you can arrive at many ratios, but yeah, this is the first ratio that one should be looking at.
So maybe, even when you have to kickstart your personal finance management journey, this is literally the first ratio you start off with, and that's the 50-30-20 ratio, or more commonly called as perhaps the budgeting ratio. 50% towards expenses, and 30 and 20 between savings or investments and spendings. The other ratio, which is of course gaining a lot of relevance, as we are in the midst of this COVID crisis, it's unfortunately led to a lot of individuals either losing their jobs or facing a lot of disruption when it comes to their business, and that's when this ratio comes in, into play, and that's the emergency fund. Mr. Subramanyam, how should one decide on their emergency fund? What would be step one of the process?
See, first of all, emergency fund for everybody does not remain the same. So somebody, let's say a young person who's 28, 29 years of age and has a rich parent, okay? And let's say the guy is married, he is working, his wife is working, then both his parents and her parents are rich. Like such a person may not need a very high emergency fund ratio. Maybe 2 months expenses or 3 months expenses is fine, because he knows he can always dip into the parents' emergency fund. However, for a person who is supporting his parents, maybe paying younger brother's school fees, or supporting a younger sister who is studying, right? So somebody who's got more dependent should obviously have a greater ratio. So somebody could have 3 months expenses, somebody could have 2 years expenses. And also, if a person is very highly paid in a specialized job, remember, Mubina, a pilot can't get a job as anything other than a pilot. So if you're a pilot, you have to wait till you get a pilot's job. Whereas an accountant in a cement company can get a job as an accountant in a bank. It's not so difficult. So if you're in a very specialized kind of a job, you need to have a greater emergency fund. So for each person, it will be different. So if you have got, say, zero emergency fund and you want a target of 10 lakhs as your emergency fund, then you suppose you have 50,000. Then 50,000 goes to the numerator, 10 lakhs goes to the denominator, and you keep looking at every day saying, how do I increase this to 10 lakhs? So right now I'm at 5%, I need to keep increasing it. So you will look at that ratio and you know where you stand on a regular basis.
Okay, so it's also important to understand how your expenses as well are changing. Every year, every incident that transpires, how your expenses are changing as well will be very important to understand. Term life insurance. Unfortunately, the fact that we are in the midst of a health crisis is something that has thrown a lot of light on the importance of having, well, not just a life insurance, but even a health insurance for obvious reasons. Mr. Subramanyam, while people may come to terms with paying a premium and shelling out this expense from their pockets, what sometimes people often get confused about is how to select the sum assured. What would be your advice on that front?
Okay, sum assured again is a function, like I said, Mubina, for a guy whose wife is a housewife and she is not capable of earning. Obviously, he has to have a greater amount of money available. But if, let's say, a husband is a doctor and wife is a doctor, and both of them are earning equally and they don't have children, then obviously they need to have a lesser term insurance. However, for somebody with more dependents, he should have more. Largely, the amount of term insurance a person requires is a function of how much they are spending and how much loans they have. So a rich person need not really have much of insurance, but a person on whom more people are dependent, he should have more. Normally, the thumb rule which is given to you is to say take 10 times the annual salary. But you have to take this with a caveat. This is true only till you're about 40. Beyond that, your salary will be higher and your liabilities will be less. And by the time you're 55, perhaps your children are very close to settling, and after that, you may not require much insurance. So the question is what your insurance should do. It should pay off all the liabilities and it should provide enough money for the family for another 10 to 15 years. So that is the amount of insurance that you have. But largely the ratio that is shown to you is to say, take 10 times the money that you earn, and that should be enough. So a person earning 20 lakhs a year, he should have about 2 crores of insurance.
All right, well, there you have it. That's, of course, when it comes to a term life insurance, something that is obviously an absolute necessity. And we're talking about a plain vanilla term life insurance. That is something that almost everybody can buy. It's one of the cheapest forms as well of life insurance that one can purchase. Okay, now Mr. Subramanyam, you've spoken about mortgage as well. However, it's more of a concept from an American standpoint of view. But if we have to sort of, make an Indian version of it, and that's a lot of individuals who've been taking home loans, to pay and sort of paying down their EMIs of sorts to, pay off for that home loan. Now, you mentioned a little bit about these EMIs in the 20, 30, 50 budgeting ratio. But do you think that firstly, when taking a home loan or even looking at a budget to purchase a house, one should, to what extent one should essentially keep in mind what their current income is, what their prospective income will be in the next couple of years, and how will their affordability of the EMI that will come up every month, which they'll have to pay on the home loan, fit into their budget and their finances?
Mubina, what happens is when people are taking a home loan, they're very optimistic about life and all that, right? Only an optimistic person takes a loan saying, okay, tomorrow my income will go up and I will be able to repay. But take a young couple, they take a they take a loan to buy a house, and suddenly the wife can't work, she gets pregnant, and she's advised bed rest. Her income goes for a toss. So how will this guy pay the EMI? So you have to take all the negative things also when you are being asked to take a term insurance or even a loan for buying a house. Everybody around you encourages you and say, don't worry, salary will go up and all that, but it is not always true. So if you're taking for husband and wife together taking a loan, just ignore one salary, any one person's salary. The lower salary you completely ignore and take all the other ratios, and make sure that your car EMI, house EMI, everything put together is not more than 30 to 35% of one person's take home salary. Because everything looks very good when you're taking the loan, but afterwards, if you can't pay for whatever reasons, you will lose the house, because over first 5 years, you're largely paying interest. So if something goes wrong, you will not be able to repay the loan, and then you will lose the house. So make sure that the EMI is less than 30%. And if the husband and wife both are earning very well, maybe make it 40% of one person's income, and which means you'll have to live on the other person's income till if nothing goes wrong, that's fine. But otherwise, overcommitting, you don't hear stories about people who are overcommitted, but people who are overcommitted lose the house, and that's very sad.
Overcommitted, overconfident as well, like you mentioned, overly optimistic on their future. That's perhaps the reason why obviously you take a home loan, because a home loan pay down is spread over 15, 20 odd years. So yeah, 35% of one person's take home income, that's what the EMI should essentially not exceed, or the home loan payments should not exceed. All right, let's move on and talk about investing ratio. We often talk 100 minus age, that's the amount that you should put into equities. Why does this essentially work, Mrs. Subramanyam? Because remember that we live longer lives as well. Longevity is something that's key. And furthermore, it's this whole, sometimes making wealth or creating wealth is all about asset allocation. So why does such a simple formula, seemingly simple formula of 100 minus age work when the task at hand is something that seems very daunting? That's asset allocation.
Yeah, but look at it this way. How many 30-year-olds would have 70% in equity? That is what they're allowed to do. But it doesn't happen, because what happens when a young kid starts working at 24, 25, the parents anyway ask him or her to open a PPF account, take a endowment policy, then he has his or her own PF. All that is anyway debt. So no way how a kid who is 30 years of age has 70% in equity. It just doesn't happen. So going forward slowly, when you're about 50, at least then you should come to a 50-50 into equity and debt. Also, it's a question of how comfortable people are investing in equities, because then you should be willing to take the vagaries of a market which will go up and down. And if you're not comfortable doing all that, so this is a thumb rule which says even at the age of 70, you should have at least 30% in equity, because you have to provide for inflation for another 20-25 years. So yes, therefore 100 minus age, but there are some people who would say 110 minus age if they want to be a little more aggressive. But if you have a lot of money, you need not be aggressive in equities, because you have to first make sure that you have enough money for the rest of your life. And after that, the excess money that you have, with that you can be aggressive. So yeah, India is not a very aggressive country. People talk about equities, and you are in Western India where people have at least heard of the equity markets. But if you go 50 kilometers beyond Thane, then people have largely investments in debt instruments.
All right. So yeah, basically the idea is switching from debt to equity, and obviously, as your age increases, you need to accordingly change your asset allocation as well. So while at 30, maybe 70% of your portfolio needs to be in equities, but maybe at 50, you need to change it down and trim it down to 50% or lower. Okay, retirement. Mr. Subramanyam, we've discussed this very often, and yes, while we say if you're looking for retirement and if you're young and if you're long, that basically means you're a long-term investors, equities is the way to go. But I think the tricky part is many times, and I'm sure you will as well appreciate this, when we get our queries from viewers, they say that okay, I'll retire in 20 years and I'll need 3 crores or 4 crores. So there's sometimes gross underestimation of how much an individual will require to fund themselves for retirement. And like I mentioned, longevity as well is a factor, thanks to long lives that people are leading. It does tend to sort of up the expense bill as well. So how do you decide how that you'll need for retirement, and of course while we're at it, how can we achieve that goal as well?
See, first of all, when we are very young, let's say you're under 30 years of age, there is no way how you can estimate how much money you need for retirement, but it's a big number that you need. Only when you're around 55 years of age will you be able to come to an approximately accurate number. Right now, if I were to do retirement planning for you, I would say just tell me how much money can you spare, which you need not touch for another 35, 40 years, which will become your retirement corpus. So whatever amount you put away, 10,000, 15,000, I would just say put it into a dabba, which is called a retirement dabba, which you will not touch till you're say 65 years of age or till you retire. So first you start with that, then slowly you get into a more accurate number when you're 55, 60. The thumb rule around the world is to have $1 million apart from a house and having zero debt, and which means about 7.5 crores for a person retiring today. But of course, it depends on his or her personal expenses. The other formula to look at is to say to have about 40 times their annual expenses. So for somebody like you will not be able to estimate how much will be your annual expenses at the age of 60, but I will be able to estimate how much I need at the age of 60 because I'm very close to that age. So if I say I require say 10 lakhs per annum as my expenses at my age of 60, I would require 10 lakhs into 35 to 40, which is 3.5 to 4 crores, right? So right at your age or even younger than you, people should just start putting money away, knowing that they will not touch it for another, like if it's a 22-year-old, another 38 years, I will not touch it. And right now, I don't need to know how much I require. I just need to know I will require a big, nice, round sum. So just start investing. That's important. You will never be able to estimate how much you require till you're much nearer the goal.
And finally, Mr. Subramanyam, we all like to put a number to ourselves. Are we in the 2 comma club or 3 comma club? And that can be estimated via net worth. Now, especially for younger people, they may be a little confused. I mean, what's my net worth, right? Or if I've just been maybe 7, 8 years of working, all I have to my name is a salary that I've accumulated maybe in these last 7 to 8 years. Assets may take a little time. So, how can one determine what their net worth ratio is?
Luckily, in this country, there is no choice, but you have to pay for your PF. So I'm sure you have accumulated some provident fund. You would have, if you have bought some endowment plan, that would have accumulated some value. And because you are young, you may have put some money avail in ELSS or in PPF. All that together is your asset. Now, if you have bought a house, that is again your asset. And if you have taken a loan for that, that's your liability. So just add up all your assets, reduce your liabilities. That is your net worth. It may not look very impressive, but today at least it's a start that you've made. And your only aim in life should be to increase net worth. How do you increase net worth? The value of your assets going up and the value of your liabilities going down. So, suppose you have a surplus, you have to ask yourself a question: should I invest this or should I repay the money? Very clear that if your investments is giving a better return, if it is giving say 12% return and your home loan is at 8%, obviously you should be doing more investing and less repaying, because that's giving you a better return. After some time, you will be able to repay all your loan and your assets would have gone up. So your net worth would have gone up. How do you calculate this number? Assets minus liabilities. Create an Excel sheet where the assets are being updated on a regular basis from some website, all your mutual fund, your ULIP NAVs. That will add up all your assets on a daily basis, and from that you reduce your liabilities. So every day you know what is your net worth. Once you start looking at that number, it's a very important thing that that number does not go down and it increases by at least the rate of inflation. So if inflation is about 6%, your net worth should be increasing by 7 or 8%. It's as simple as that.
Okay, well, time to take on board our viewer questions and queries. Then remember, folks, you can as well connect with us on the Money Show at etnow.tv. So let's take on board our very first question. Narayanan Iyer says, could you please advise with respect to his investment decisions? He has 2,000 rupees SIP going on with Mirae and HDFC. He's not mentioned specific funds. This has been going on for 3 years, but now he has another 3 lakh rupees and he wants to know if should he buy more mutual funds or should he now move over to buying individual stocks? Okay, well, interesting question over there. I mean, it's just been 3 years since he's investing in mutual funds, and I would reckon that it's just been an SIP that's getting constantly debited from his bank account. I don't think he's really been reviewing it much. But yeah, he wants to now dive into stocks, and I suppose Mr. Subramanyam won't be a little surprising because we've got so many, people who've been eyeing the stock market sitting at home in this lockdown and thinking how they as well can make a quick buck. What's your view?
I have no clue from where people get this overconfidence of getting into the market with just 3 years of SIP. Look, it's a far more complicated thing entering the equity market. And the worst thing that can happen is he will have some beginner's luck. So he may even make some money and then he will lose big money. So I am anti people getting into equity markets directly unless they have a friend or guide who can teach them how to do it. Or qualification. He does not see the fact that he has given details, just saying HDFC and Mirae is not sufficient. He's not even said mid cap, large cap. So I don't know the ability to handle the vagaries of a direct equity market. I would rather have him put money into index funds rather than entering the market directly. In a bull run, everybody can look smart, but once the bear run comes, he will do badly. He's not and he has just said 3 lakhs. He has not said what he wants to do, what time frame. So I would just put money in an index fund slowly. Even that I would do an SGP rather than lump sum.
Well, trading is definitely injurious to your wealth. I think that's what Mr. Subramanyam as well does truly believe in. And yeah, remember that even if you may get a little bit of beginner's luck, that actually can be quite a lousy teacher, may nudge you towards overconfidence and perhaps even make you take more riskier bets. And the downfall, if any, could be quite devastating. So definitely only if you have some guide, a solid guide who can sort of help you through this journey of trading and investing in individual shares, only then dive into that world. Okay, let's move on and take on board our next question. Kannan PK says, I've invested more than a couple of lakhs in the Nippon India Equity Hybrid Fund in 2017. Presently, this is very much on the negative, even while the market has recovered. He wants to know what the future of this fund is. Now, Mr. Subramanyam, the reason we decided to take on board this question is also because I'm sure a lot of individuals may be thinking that if the market has recovered, why is my fund still in the negative? What would be your, comments to such individuals?
About this fund, I like the portfolio, though I don't like the performance. So I think you should wait for some time. And what happens is, the index goes down. It does not mean your portfolio goes down or goes up, right? So a few shares concentratedly go up. You think the market has gone up. That is not true. When you see the index has gone up, you realize it is HDFC Bank, more so it is Reliance. Reliance is 15% of the index. So when Reliance goes up, the index goes up. It does not mean your portfolio will go up. If you're in small cap and mid cap, your portfolio may not have gone up. So this portfolio is good. So he should stay on for another 3-4 years. And equity, one thing is important. If it is a decent fund house and a decent fund manager, you should exit largely when the fund is doing well. But unfortunately, that is the time when people go and put more money. So when this fund comes to a positive and does well and his goal is nearby, he should withdraw and put it into debt schemes. If his goal is not nearby, he has to just sit tight and sit calm, and nothing else he can do. And time like this, when the markets are down, is the worst time to reassess your asset allocation or to see how your fund is doing. Obviously, no fund can be doing well at this time, except a fund which is heavily loaded with Reliance or HDFC Bank or things like that. So I don't think he should be reviewing now, but it is a good fund and it has got a good portfolio. Give it time, it will perform.
So there you have it. That's Mr. PV Subramanyam's opinion on Nippon India, the hybrid fund. Sorry. Okay. Third query. Sutinder Gopalakrishnan says he had invested quite a bit of money in CPSE ETF and Bharat 22 ETF a few years ago. So he bought it at 26 for the CPSE ETF. It's now at 17. The Bharat 22 ETF, it was at 35. Now it's at 25. So he wants to know what should he do. Does it make sense to average it out by buying more of it now? Should he further invest in it? Mr. Subramanyam?
Yeah, actually, what happened is 1994, when Mr. Modi came to power, everybody was very optimistic about what he would do with the PSU shares. Now, again, the government doesn't have much money, so perhaps he will pay attention to what is happening in the PSU. So some PSU will be sold. The minute BPCL is sold, I think all the other PSU shares will go up. And for investors who do not know, both these funds are PSU shares, right? These are ETFs, but the underlying portfolio is PSU. He should hold on because the government, which doesn't have money, will have to sell these shares. So yes, he should do an SIP in these funds on a regular basis, and that will reduce his cost. He should hold on till some of the PSU announcements and sale announcements happen. So right now, it is a good time to be buying rather than selling. And you should give himself about 2-3 years time. By the time, if he averages, his cost would have gone down. And if the funds do well, he can sell it off at that stage. So right now, don't sell. If you want, you average. If you don't average, that's also okay. But at least don't sell now.
Don't sell now. If you want to average, you could, but don't sell now. Doesn't make sense to book losses right now. Well, Mr. Subramanyam, thank you so much for such an enlightening session and, introducing us to the concept of personal finance ratios. It's definitely quite an easy way as well when you put numbers across, your spends, your expenses. When you put it in the form of percentage or ratio, it definitely does make their management too easier. So thanks so much, Mr. Subramanyam, for joining in. If you've missed this episode, you can catch it on ET Now's YouTube channel. You can always stay connected with us to get your questions and queries answered on The Money Show at etnow.tv as well. For now, we'll slip into a very short break, but when we return, we'll be touching base with Mr. Bharat Panchal to talk about what PM Modi has in mind when it comes to a cyber security policy that seems to be on the anvil. Don't go anywhere.